All right, welcome everyone. Welcome to the Innovation Room at the New England College of Business. So where are you? So we have those in the audience today as well as those of you who are attending virtually. The New England College of Business has been offering education since 1909. And in the past it was the American Banking Institute, and where we offered training for bankers to train other bankers. We've come a long way since then, but we are now a fully online college offering associate's, bachelor's, and master's degrees. Soon to open a new center full of certificates, and we have the Innovation Room. So what the Innovation Room does in many ways is synthesizes what our mission has been over the years, which is taking education and industry and bringing them together. So we hope you'll stay with us, not only for this session, of course, but come to watch us for future sessions or come to attend future sessions. Every month we have a thought leader come in and talk about something that's relevant to business industries, and today's no exception. So today we have Donna Beans, who's going to be talking about taxes, and what's that saying about the two things you can't avoid? Death and taxes. So Donna's going to make it accessible for us tonight, though. Donna is our program chair for our undergraduate business program. So let's give Donna a welcome.
Thank you. So it's tax time, and everybody loves tax time. Okay, maybe not everybody, but I love tax time. So let's talk about taxes. There's been a lot of changes this year. So if you've heard people talk about you can't file your tax return until, or there's been provisions that have lasted longer or that we're extending, tonight we're going to talk about a little bit of each of these items. So most people are used to thinking about taxes and talking about taxes and pulling out your 1040 and all the other forms that go with taxes. So I'm going to try to give us a little bit of a synopsis of all of these and what it means to you. Of course, this presentation should not substitute for professional counseling if you have, counseling in taxes, of course, if you have some complicated taxes, definitely get the help with doing them. So first we'll start with what you need to know. We'll go over some of the basics, above the line deductions, itemized deductions, credits. We'll talk about the Protecting Americans from Tax Hikes Act of 2015 that changed everything. So we want to make sure that we have some good ideas of what's going on with that. And so now you know you're getting a refund. How do you know when it's coming? And I have some tips on how to figure that out. So taxes is actually just a basic math problem. I know, again, you look at the 1040 and you go, oh my God, that's too much, it's overwhelming. It's actually just a basic math problem. It just has a lot that goes on in between the lines, and it's over 4,029 pages of information and rules. So it's a little bit more than basic math, but I think I'll give you enough where you can see exactly where everything goes. Let's talk about PATH first, the Protecting Americans from Tax Hikes Act. One of the big things that happened with this is 50 tax provisions were either extended or they were made permanent. So some of the ones we'll talk about tonight, enhanced child tax credit, the enhanced American Opportunities tax credit for people in school, enhanced earned income credit, teacher supply deduction. This one's a big one because for years it's only been $250. Now this year it's $250, but it is going to go along with inflation going forward because we all realize that teachers spend a whole lot more in their classrooms than $250. So that's a great one. We were really excited about that. And then some of them that have been extended through December 31st, 2016, which means that they'll come up for debate again this year, is the tuition deduction energy credit. So if you did some Energy Star appliances, solar panels, that type of thing, you can still take a deduction here. And the mortgage insurance premium deduction. So each of these are going to be filtered throughout the presentation, but I wanted you to have a quick synopsis of some of the most important items that changed with PATH. One thing PATH did change that is going to affect a lot of people is if you are filing with the American Opportunities credit, with the earned income credit, or the additional child tax credit, you can file before February 15th, but the IRS is not going to process before February 15th. Now, I've had clients already call me and say, but does that mean that I'm going to get my refund on February 15th? I could file your taxes today and you will still not get your refund on February 15th because they're just going to begin the processing on February 15th. So that means you're looking around February 27th before you're going to see a refund in your bank account. And that's if you do direct deposit. If you do a check, expect that to be delayed to maybe the end of the first week of March. One of the other things PATH did is it gave us some better checks and balances. Checks and balances that a lot of us tax preparers say, well, why weren't you checking that already? Because they had the information, but they were able to bring this all together so that if you pay alimony and somebody receives alimony, now they can match the two of those up. We were giving Social Security numbers before of the person receiving it, but the IRS didn't have the system to put them together. They do that now. The 1098-T, that's what you get when you go to school. The school will send you a 1098-T. That is going to be required now for any education deduction at all. For many years, it was not a required form, so I could have clients come to me and say, well, I spent this amount of money on my son's education. And that's wonderful, but before, I could use those numbers based on their receipts. Now they actually have to have the 1098-T. And the increased documentation required for non-cash donations. And we'll talk about this again as we go further into it, but one of the big things to remember is if you're somebody who goes to Big Brother, Big Sister Club, you go to Salvation Army, you drop off bags of clothes, you need to have more documentation now. So when you get that receipt from wherever you're bringing it to, you need to make sure that you're writing down what you brought. The more information you have, the better it will be, and the more money it's worth, the more documentation you'll need. So that's what PATH has done for us. The other big thing is when you mistakenly or fraudulently claim something you shouldn't claim before, they had some really interesting decisions on whether or not you could claim that again. So if you claimed EIC credit and you should not have claimed EIC credit, it would disallow it, and then you could refile the following year and you could get the EIC credit. You cannot do that anymore. They are jailing your money now, or your credits now. So if you file something and they deem it to be a fraudulent claim, they will stop you from claiming that again for 10 years. If they find that it was reckless or intentional disregard, then they will say 2 years. So that's really important for people to know, especially with EIC credit, earned income credit. You want to make sure that due diligence is done and you're supposed to be claiming it. So back to our basic math problem. Let's talk about a couple of the really important things that we have here. Above the line deductions, as I mentioned, is the educator expense alimony. If you pay alimony, you get to take that above the line. IRA deductions, tuition and fees. So those are all above the line. And when I talk about above the line, it means before adjusted gross income. A lot of limitations are based on adjusted gross income. So whatever you can deduct in this spot is really good to bring down that adjusted gross income. However, there's some benefits and not benefit of deducting some of these. For example, tuition and fee, you may find, well, I want to change that adjusted gross income, but then you might find that the credit is worth a lot more. So we'll talk about some of the differences between them. Standard deductions went up this year as they usually do. If you're single or married filing separately, it's $6,300. Married filing joint is $12,600, and head of household is $9,300. And then we have the itemized deduction. So if you have items which you feel are going to add into this itemized deduction world, you can take the itemized deduction, which is as long as it's more than what you're claiming. So if you're single, if it's more than $6,300, then it's important for you to itemize and get the bigger deduction. But itemized deduction does open up a can of worms. And the reason I say that is because there are limitations to specialization to all of these. And if you've never heard of this Schedule A, it's probably because you've never had to itemize your deductions. When you start using this Schedule A, as you can tell, it's another full page of tax information to fill out. And each one of the different areas is important and has its own limitations. So medical and dental expenses. Now this is not medical and dental that you're paying through your employer. This is out of pocket. It's after taxes, so it's not before your taxes are taken out. So it's 10% of your adjusted gross income, and then anything above that, again, here's our adjusted gross income we start talking about. Anything above that you can start to apply the 10% to. Taxes you paid. One of the permanent provisions that went through with the PATH Act is You can take general sales tax or income tax. Now, depending upon what state you're from, most states are going to end up taking the income tax because it's going to be higher than the general sales tax. There are some states that don't have an income tax, so they will end up taking that general sales tax amount. Documentation is the big thing with this. You can't just tell the IRS that you paid $20,000 in sales tax. You have to be able to prove that. However, if you bought a car, let's say you buy a luxury vehicle and you pay a good amount of sales tax on that and you don't have that much of an income, you could end up finding that general sales tax is the better option. So it's good to always weigh the two of them. Real estate tax has not changed, and personal property tax, excise tax, that has not changed as well. Interest, the IRS did decide under the path to put in a small one-line item that said you cannot have a second home. So what that means is that you can have your first home and you can have a second home. But if you have a third home, you're not allowed to take the interest deduction for that. You cannot have a second home. And this was happening a lot with people that owned homes that were not taking a real estate deduction. Maybe they had children that they were having live in during college. They owned their personal house. They had one kid that was in New Hampshire, one kid that was in Connecticut, bought a house in both places, and then they were trying to take the deduction for all the interest on the mortgage. IRS said, no, we're not allowing that. You can't have a second home. So that's a big one that did come through. Mortgage insurance premiums. This expires at the end of, expired at the end of 2016, which means we can take it for the 2016 taxes. We'll have to see whether or not it's extended again. What that means is if you are paying an insurance premium, right now the IRS says this is considered interest. It's something that you're paying on your home that is required because your market value of your home or your appraisal value of your home is not high enough to support your mortgage. So they've allowed this for one more year. The phase out here though does begin at $100,000 AGI. So if your adjusted gross income is over $100,000, your phase out is going to start happening. So they definitely limited that. Job expenses, miscellaneous deductions, while there's no additional changes here, it is important to remember that documentation is key when it comes to job expenses. If you're doing something and it's to the benefit of your employer, and the employer is not paying you back, then that is a job expense. If you're doing something and it's because you just want to do it, and it's not extending your job in any way, then that's something that you can't take as a job expense. Miscellaneous deductions, again, you have, your gambling in here, things like that, some miscellaneous deductions. There is a floor to that, so you want to make sure that you're keeping those receipts and making good notes for your tax accountant to look at, because we love notes. We love to see that. Gifts to charity. There is 6 pages in the new provisions about charity, so it's important that you understand with charity that the rules have been expanded. This is a huge audit place this year. Expect yourself to at least be questioned if you start to look at some charitable items and the IRS says, not really sure that that's something you should be deducting. The biggest thing is keep your receipts. Most important thing. So with charity, one of the big ways to keep your receipts is if you give cash donations. So you give single cash donations less than $250. So $50 to this person, $50 to this person, $25 to that person. In this case, you want to keep a canceled check or a credit card statement. It is great if you can keep a written document from the charity. So a lot of charities will send you a letter that says, thank you for your donation. Those are great to keep. That's a great receipt. If you don't have that, but you have a check written out to the American Red Cross, that's fine. No problem in that situation. However, if you give more than $250 in one single transaction, more than $250, you have to have a written note from the charity. So you need to have something that says, you gave this amount of money.
And I assume electronic verification of money, like through PayPal or through the transfers, is sufficient.
Absolutely, absolutely. That in our day and age, that's canceled checks. They still call them canceled checks. Our electronic transactions definitely works.
I don't think I've written a check in a long time.
Most people have it. Payroll deductions, some of us have United Way deductions, those types of things. I always tell all my clients, keep the final pay stub that you have for the year. That is ideal. Even once you get that W-2 in and it has the numbers on it, keep that final pay stub because that is going to tell you everything that you need to know. If you're somebody like here at New England College of Business, we don't get our pay stubs, they're online, so we can go get them ourselves. I always tell people, take the minute when you're going to get your W-2 online to grab that last pay stub and have that with your tax documents. Plus, it's a good checks and balances to make sure that everything's working out right. So those are pretty much the standard deductions when it comes to normal cash deductions. When we get to bigger cash deductions, we have some more rules and requirements that I don't really cover in this short synopsis, but it is available to you if you go to the IRS website and put in charity. The place that I wanted to focus is where they really are going to hit the audit flag this year. This is every conference I have been to, every training that I have listened to has talked about audit flag at non-cash donations. So, if you're giving a non-cash donation, what I tell my clients to do is even if you know that they're going to give you one of those little red slips or little yellow slips that says you gave money, I usually take that and before I left the house, I take that bag of clothes and I just mark down what I have in there and a fair estimate. So let's say I have twin 3-year-olds, I'm going to take their stuff and I'm going to go dump it off at somebody because I don't need it anymore, they don't fit in those clothes. I'm going to just put down, okay, 5 pairs of pants, 10 shirts, 3 sweatshirts, no big deal. I know those clothes are not worth millions of dollars, so I'm going to do a nice, easy, fair market value of what they are. If you're giving away a very expensive suit, very expensive shoes, something that's expensive and you feel you really know that the value of that is much higher, what I usually suggest is if you're going to fill out this piece of paper yourself, I usually suggest going online and getting a printout of what the value of that item is. You can do that simply by going online and getting what the market value of it is, and then you're going to have to do a little bit of writing down because they're not going to give you market value for it. But you can also go to the IRS website, they'll also give you an idea. You can also talk to a lot of the charities, they have a book that will tell you what something is worth. So that is important when it's something that's $250 or less, you get a written acknowledgement or other reliable record. And this would be a reliable record that they would, and this is just a piece of paper that I make up myself that says I gave this and this is the fair market value of it or the number of goods and who I gave it to. If it's something that's more than $250 but not more than $500, we want a written acknowledgement from the charity. Anything above $500, and now you're filling out separate forms for the IRS. The one thing that I want to point out here is, let's say any non-cash contribution over $5,000 of a similar item. So let's say I go and I say, okay, I'm giving $6,000 to so-and-so charity of household goods. I have to have an appraisal for that. I have to actually get an appraisal of that. However, if I go and I say I'm going to give $6,000, but $3,000 of it is furniture and $3,000 of it is miscellaneous household goods, I do not need an appraisal for that because I can separate them out as non-similar items. So that's important to know if you are giving something worth a lot.
So quick question for you, so on that same vein, so let's say you made donations over the course of the year, and they are, well, one is miscellaneous household goods, and that was in February, and that was $2,000, and then there was some later, and that was $3,000. Does that work the same way?
Yeah, so you keep them
Because
separately.
it was separate time of
Separate
year,
time,
even if they were the
separate-
similar kinds of items. Okay.
Absolutely, absolutely. Because if you think about it, when you were to write those down, you would actually be valuing them differently because you're giving them away at different times. So you can certainly put that down. So that's our charities. Back to our basic math exemptions. Most people talk about exemptions. You know that it's $4,050 per person. Your phase out does begin at $155,650. Who can you claim? The best thing that I can tell people is if you don't know if you can claim someone, go to the IRS and work on their interactive tool that says, who can I claim? Because they will ask you the questions as you're going through it. For example, if you're supporting a elderly parent and that parent does not live with you, you can still claim them as a deduction, as an exemption. You can still take that exemption for them. However, when you start to look at children, I have, you know, a freeloading 21-year-old that lives at home. I can't claim him anymore. You know, he makes his own money and I can't claim him. He's mine. I gotta pay for him, and if I'm gonna keep feeding him, that's too bad. The IRS says that's up to you. You know, it's not our fault that you want to keep supporting them. So you have to look at what, you know, who can you really claim. One of the big areas that I happen to be involved in, quite a few places that talk about the adoption credits, foster children, that type of thing. Be very wary of that, because a lot of people will tell you that, oh, well, you only had them for 3 months and so you can't claim them. Not necessarily true. If you have a formal adoption and you adopt them, it doesn't matter who had them at the beginning of the year, you have them as an adopted child. Nobody else can claim them. So be wary of that. If you don't get your answers here, and you can't get an answer from somebody who knows the adoption and foster system or knows the exemption system, call the IRS. Because the IRS, especially local IRS offices, will help you and will give you an answer. The only thing is, if they don't give it to you in writing, make sure that you heard what they said, because they're not going to support you if you heard them incorrectly. And that does happen. So now we're at taxable income. Once we get to taxable income, this is really an important place, because this is when we use the tax chart and we determine what is your tax. So once you determine what is the tax, that's what you owe. Now we have, of course, it's a basic math problem, but there's other stuff below this. But that really is your starting point for how much more can I get back, or how much more am I going to not owe. So when we start to look at our credits, which are going to subtract from our taxes owed, or our other taxes, which are going to add to our taxes owed, these are really where they start to get to become some important information. The most wonderful thing about the IRS is they love tax forms. So each one of these areas, if you want to take a credit for your child care expense, there's a tax form for that. If you want an education credit, there's a tax form for that. The best thing that you can do is don't pull out the tax forms. Get an online program or a professional, because they're all linked. So when you go in, if you do one of the online systems, it'll ask you the question, did you go to school? Now, I'm not saying that they're always correct, and but if you have basic taxes, those can help you understand whether or not you need to take those, or you can take those credits. With regards to some credits, such as child tax credit, we're going to talk about this again in a couple of screens from now, because it gets you here, but then it's going to give you some more back later on. So you want to make sure that as you're filling these forms out, you're reading all the directions if you are filling them out. Especially when it comes to certain credits. I put the adoption credit up here. The form is the 8839. Guess what? It's not even listed on the 1040. There's a box 54. It says other credits. So don't think just because there's not a specific place for that, that you don't have a credit. If it's something that you're saying, I know there's a credit out there for this. Now that happens to be a $13,000 credit. You know, you certainly want to go per child. You certainly want to go look for those forms and see if you're eligible for it. Again, a computer system would help. A tax professional would know those questions to ask. But for those people that are doing it on your own, make sure that as you're going through the 1040, you're checking those boxes and seeing if it says other somewhere and you don't know what other means. Definitely go onto the IRS website and say what other credits are available, because they'll be here. Other taxes that you're going to see. So you may have self-employment tax. If you receive a 1099 and you have some self-employment income, what happens is at the beginning you're going to above the line have a tax deduction, but below the line you're going to have to pay taxes. Because remember, that's what happens when you get a W-2. Your employer paid taxes and you paid taxes. So they look at those numbers and you would have to pay your taxes here. Additional tax on IRAs, 401ks, things like that. If you start taking money out of your 401k, you're going to have some additional tax that's going to go here. Because while most of the places will take out the original beginning Penalty, this is where the tax penalty is paid. Household employment tax, if you have a household employee. And then we have our healthcare penalty. So this still is in existence this year. And what you need to remember is that if you don't file this correctly, the Obamacare, if you don't file correctly that you did not have health insurance through the whole year, if you missed a month here or you missed a month there, the IRS will pick up on that immediately. It's an immediate system. They'll know about it before your taxes are even processed that you did not file that correctly. So make sure, and I say that, but of course it is the IRS, so it could take them 3 years to find it, but they do have 3 years to find it. So make sure that in this case you want to definitely take a look at it. You should receive a form, a 1095 form. Don't throw that away. That's a very important form. That is going to say, yes, you had health insurance the entire year, or no, you did not. Now, if you did not have health insurance the entire year, for example, you switched health insurance companies, let's say you had health insurance through Blue Cross until June, and then July you had switched jobs and you got the health insurance July through December through Tufts. That's okay. You're going to get 2 1095s and you're going to file those 2 1095s for having both. If you have a month that you skipped in there, then you have to do the calculation to figure out your penalty.
So everybody gets a 1095?
Everybody will get a 1095. You'll get a 1095
Mail.
A, B, or C, based on whether or not you bought your insurance through the marketplace as a separate individual without a company backing, whether your company backed health insurance, or if you have some self-employment, some separate type of process. Okay. So when we get back to our basic math problem, so now we've come up with total taxes due. Now we have some tax payments. Now this is where our path comes in again. So you have two things you're going to hear about. You have non-refundable credit. A non-refundable credit means that you can work off, think about jogging at the gym. You can jog off all those chocolate calories, but you can't lose weight that way just by jogging those calories off. You'd have to keep jogging to get more. Well, in the case of the IRS, once you've jogged off those tax calories, you can't go any further with a non-refundable credit. But with a refundable credit, after you've gotten rid of all of those taxes and you now are at zero, you owe them nothing. They owe you nothing. You're at zero. You can now get money back from the government that you did not even pay in. So these are called refundable credits. So you can get a refund for even more than what you had originally owed. So there's a couple of refundable credits that we're going to talk about. Additional child tax credit, the earned income credit, and the American Opportunity Credit. If you were paying attention at the beginning of this, you remember I mentioned those were part of PATH. I also remember, if you remember, I also mentioned that if you are filing those 3 credits, you cannot get your refund until after it's processed on February 15th. So what the government said was, okay, we're going to give you money back that you didn't even pay us. It's okay, we're going to give it back to you, but you have to wait to get it back. You cannot have it until after we realize that you definitely paid in what you say you paid in. How is that going to work out? Well, 2 things that happened with the IRS. The first thing is they changed the due date of when employers have to get their W-2 information into them. So now they have a quicker system. They also require more employers than ever before to file those W-2s electronically, which means they're in the system. So they can do a match-up. So they have some more checks and balances that go on when they're going through this process. So in talking about each one of these, it's important that we look at the fact that there is a refundable piece to it. It's not always 100% refundable. We talked about the child tax credit, and that reduces the amount owed dollar for dollar, and then it stops at 0. That part of it is not refundable. But then they gave us the additional child tax credit, and they said, well, you know what? We're going to give you a little bit more because we know how much those little stinkers cost, and we're going to make sure that you have a little bit of extra money there when it comes to paying for it. So what they decided was, with the additional child tax credit, they're going to give you $1,000 per child in addition that's refundable. So the way that this works is you have a total tax due of $500. The child tax credit of $1,000 only allows you to take 500 because that's all you owe. So you ended up at 0. Remember, you worked off of those tax calories. But what they say now is, okay, we understand that, but you still had an additional $500 here, so we're going to let you take that additional $500 as an additional child tax credit. But you've got to wait until the 15th before it's going to get processed. So that one is a pretty simple one. You just need to fill out your child tax credit form. And once you've filled out the child tax credit form, it tells you on it, okay, now you filled this out, but wait, there's more. You might be eligible for another credit. So let's wait and see what's going to happen later on in the process. So make sure that as you're filling that out and it says, wait, you know, this is how much you can take, but wait, there's more, keep going. A lot of people see that stop and they just stop. We want to keep going. And that one happens to be one of the more tricky forms. So again, if you're filling them out by hand, you want to make sure you're paying attention to that. The earned income credit, $15.6 billion. That's a nice big capital B. $1 billion in earned income tax credits were issued erroneously or improperly. That means people filed for the earned income tax credit and got money back that they should not have gotten. Okay? This is huge, huge this year. You want to make sure that, obviously you can't file it until after the 15th, but you want to make sure that if you're eligible, let's say you have 3+ kids and you make $53,505 and you're married filing joint, if you make under that, you want to make sure that when you're filing that, you're filing for that credit of $6,269 as a maximum credit, but you want to make sure that you're not saying you have 3 kids and you're counting your dog. You can only count the 3 kids that are actually kids. This is a huge audit me flag. The IRS is going to audit. They're not only auditing tax preparers who are filing EIC credits, they're filing the taxpayers. So, for example, if a client comes to me and they want to file and they deserve to get this earned income credit, it's about, if I print it out, it's about 7 pages of questions that I am required by IRS rules that I go through and make sure that you qualify for that deduction. At the end of that process, you're saying, yes, I agree that all of these things are correct. I'm saying, yes, I agree that I've questioned you on all of these things. The IRS comes in and says, are you sure you asked them? Are you sure you asked them if that child lived with them the whole time? Are you sure you asked them if they actually paid for that whole entire year for that child's well-being? Are you sure? Make sure, are you sure? Don't question this. So if you're tax preparer, if you are filing and you are under the income limits and they start asking you a lot of questions, they're not being nosy, they're being diligent, and that due diligence is going to save everyone. And again, within a program for tax preparers especially, we file on the program, we're going in there, we're marking it off, we're signing it electronically. The IRS is then able to see that we've done that question by question, okay? If you are doing this yourself and you're doing it by hand, which I highly, highly, highly hope you're not. There's a lot of programs out there, and if you qualify for earned income credit, most likely you qualify to go on and do the taxes for free with the IRS. Go to IRS free taxes. Make sure you're at an irs.gov site, and you can do your taxes for free through one of their qualified people. Most likely, if you're filing here, you go do it on some type of computer, because if you do it by hand, you could definitely end up being audited. They're definitely going to ask that question. And again, it's mostly just, you know, one of the things with PATH that they came out and said is we're paying so much to people who don't deserve to get this, that the people who do deserve this money, we don't have any money left to give them at the end. There's no money there because it doesn't make sense. The checks and balances aren't working. So hopefully we're going to see less of that. The last one is the American Opportunity Credit. So this American Opportunity Credit, if you're in school, you're paying for some schooling, the credit is $2,500. It's 40% refundable, so 40% of it, you'll pay down your taxes, and then an additional 40% of it will can be refundable to you. You have to have that 1098-T, as I said. You cannot, this year the IRS did specify that, and you cannot take a computer as a deduction here unless you can validate it. So, for example, NECB is an online school. NECB has a reason to have a computer. You have to have it. You cannot possibly do schooling without it. You could support that deduction. My suggestion for clients is always to be on the cautious side when doing that. So if I bought a $2,000 computer, I would say, okay, $2,000 computer, maybe $700 of that computer's worth is what I used on schooling. It's time-wise what I have in schooling. So we kind of look at it like a home office. How much of it are you actually using for home office and how much is carrying your clothes, you know, or other things? Is it your storage room and you just kind of got a little desk in there? So make sure that you're cautious with this. Most important thing is you need to have that 1098-T. So with education credits, I know many people know that there's 3 of them. There's the American Opportunities Credit, there's the Lifetime Learning Tax Credit, and there's the Higher Education Tuition Deduction. Now, Lifetime Learning is forever, as well as the American Opportunities now under PATH is a forever credit, so that's always going to be there. Higher Ed is supposed to go away at the end of 2016. We'll see what happens going forward, whether or not it does. Each one of these has benefits and pros and cons to them. Make sure that you're weighing your options. Take out your 8863 and go through it from beginning to end. If you're doing it by hand or on the computer, make sure that you're checking to see, is it better for me to take the deduction above the line and reduce my adjusted gross income? Or is it better for me to do a dollar for dollar reduction and potentially have 40%? Or am I not even eligible for either one of those, and maybe all I am is eligible for this lifetime learning credit? So these are some that you really want to work through. Most of the time, if you have a good professional tax preparer, they're going to weigh these options and they're going to take the one that gives you the best possible outcome. So if you're doing it yourself, make sure that you're watching. There are phase outs though. The government has said, you know, under American Opportunity Credit, if you're let's say married and you know you're filing a joint tax return, there's a threshold that they're going to say, wait a minute, after that you don't get to take it at all. So make sure that you're aware of each of these different thresholds. So back to our problem. So now we figured out, okay, we have underpaid or overpaid. Well, let's say we're getting a refund. If we're getting a refund and your tax preparer says to you you're getting a refund, or you filed and you know you're getting a refund, every day this is going to update this, where's my refund? So when you go in here, one of the most important things is that you have your social security number, you know what your filing status was, and most important, you know the exact refund amount. If you're off just a little bit, it's going to kick you out of the system and say, nope, don't know who you are, don't care. Sorry, go away. Most of the states have this as well. And a lot of times, after you file your federal tax return, within a few days the states have them as well, because you filed your state tax as well. They'll have this up and running also. It only updates, they want us to keep telling people this, it only updates every 24 hours, so you don't need to sit there and click update, 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 update. It's only going to update every 24 hours. So no matter what you do, that's what you're going to end up with. So it's important. It's important to track your refund. If, let's say, it's after February 15th and you are filing with EIC or American Opportunities Credit, and it's been processed, but it sits there and it sits in the queue for 7 days, okay? 14 days. Now we're at a point where we're at 2 weeks. The question needs to be, why is it taking so long? Because the IRS will say on most situations by 21 days that has been paid. If it has, it'll show it's processing, it'll show something. If your tax preparer says, but I filed your tax return, or let's say the non-tax preparers say, well, your tax return is filed, but you're waiting 21 days, 28 days. You're coming on a couple of months here and you're saying, wait, where's my tax refund? Come on, paying all this interest on this loan you gave me, but I don't know what's going on here. Keep an eye on it. Be savvy about your taxes. That's an important place to make sure that you're keeping an eye on it. Some other important items. So the IRS came out and said, with the Supreme Court, that marriage and taxes are genderless. It does not matter whether it's husband, wife, wife, it doesn't matter what gender you are. If you're in a state that recognizes same-sex marriage and you're filing both federally and state, you have to file married filing joint. Now, this went through the court system because a couple of situations, but one particular one that came out is two people got married, same-sex couple got married in a state that recognized it, and they continued to file single. They each filed their single returns so that they didn't get the marriage tax. IRS came back, hit them with the penalties, made them go back and restate, and said if you're married, just like a man and a woman, if they get married, they can't still file single. They would have to file married filing separately or married filing joint. So be aware of that. And then the other thing is the expiring individual taxpayer identification numbers. If you have an individual taxpayer identification number, you probably know you have it. It may be for a certain reason, whether it's because you don't have a social security number. Many times children in foster care get individual taxpayer identification numbers so that the parents can't, the original biological parents can't file. If you have them and you received it before 2013, it is now expired. That means when you go to file your taxes, your tax preparer or whoever files them is going to say you can't file your tax return. You need to reapply. And that's going to take you 28 days to reapply, get your new estimated, get your new ITIN number. Also, if the middle digits are 78 or 79 in here, regardless of what the other numbers are on the two sides, if it's 78 or 79, it's expired. So one of the things that they are going to do is every year they're going to expire a few numbers, a few of these middle numbers, and have you reapply for it. And that's so that they can verify that you are who you say you are, so that they can make sure that there's not a reason for you to use your social security number versus this number, and so they can keep a tracking system on where these are going. So make sure that you're aware of that if you are using an ITIN number. Looking forward, what do we have to look forward to? Well, if you are in the wage base of $127,200, you are now going to be paying more FICA tax because Social Security has decided that instead of being $118,500, and they stopped taking Social Security tax out, now it's going to be $127,200, so you're paying over $600 more in taxes. So you're not really going to see that. It's just not going to stop when it would have stopped. So you're going to keep having a little bit more taxes. Expiring provisions that we need to look at. And again, I've mentioned these before, the mortgage insurance premium, tuition deduction, work opportunity credit for employers, that's 2019, the accelerated AMT, that's 2019. These are things that are on the board to expire. As we all know, Congress loves those last minute, December 20th, conversations of what's going to expire, what's not going to expire. I always tell clients the best thing for you to do is to plan on things expiring, so don't plan on getting those deductions, and then if you get them, it's like getting an extra Christmas present. You're great. So IRS reform and taxpayer reform has been demanded by taxpayer advocates. We are going to see many more checks and balances. We're going to see many more rules come up in this next year. Who knows what they'll be attached to? Last year we attached a lot of stuff to a highway bill. You never know what they're going to be attached to with Congress, but we want to make sure that we're keeping track of what's happening when they mention these tax things, because if it does affect you, you want to definitely plan for that. Now, this is a new year, so for 8 years we've kind of known where things were going, we kind of knew what was going to happen. We have a brand new Congress, we have a new president, we have some major potential changes. I don't know what's going to happen because I don't read Donald Trump's mind, nor anyone else's, but what I can tell you is that I have read his tax plan, and what we see so far in the tax plan is that he has mentioned, not He hasn't done anything yet, so this is just what he's mentioned. He's mentioned that he's gonna go from 7 tax brackets to 3. So instead of having everybody spread out, he's going to say you're either in 1, 2, or 3, with the highest being less than what it is now. It's now 39, it's gonna come down. He's going to increase personal and standard deductions for people. He is going to look at your income and not phase it out as quickly. Net investment income, which probably means nothing to most of us, is going to change and be eliminated. This one I do hope gets through, I have to say. Above the line childcare cost. So instead of waiting until after and you get a little bit of a credit for the thousands of dollars that you pay in child care, this will be above the line, it'll come off of your income, it'll reduce the amount of tax. And he's talking about eliminating the alternative minimum tax. Some of these are only going to hit those high income people. Others are going to be socially conscious and help those that make a little bit less. So that's our look forward. I cannot predict what is going to happen, but I am confident that a lot is going to happen in the next 6 months, and we need to be very aware of how that affects our personal tax stance. That is going to be very important. When in doubt, hire a professional, not non-professionals. Make sure you hire the professionals, because they are certainly going to have your back and not charge you as much as you may think. So definitely look for that logo, that CPA. That e-file is another important one. Make sure that you're going to get e-filed, because you'll get your tax return faster. Because you decide on direct deposit does not mean that you're giving the government your bank account information that they can go and take money out whenever they want. You have to approve them to do that if you wanted them to. They are going to put that money in, that the rest of the information is not. I have clients, some older clients, who think if they give their bank account number out, the IRS is going to decide one day that they want money and they're going to just take it from them. That's not going to happen. They have to go through the court system to get a right of law to say that they can take it. That's the other thing, one thing that many people don't know, and I don't have it up on the slide, but many people don't know that the IRS does hire outside contractors to collect taxes, but an IRS tax collector who is actually collecting tax, you will know that you owe the tax, first of all. Second of all, it will not be the first time you've heard about it. They will have sent you mail. They will have certified that mail. They will have done many other things before calling you on the phone. The last thing is, if somebody does call you on the phone and they say that they're from the IRS and they're collecting taxes, and you think you might owe some taxes, ask them for their number and their IRS certification number and call them back, okay? And if you ask them for their number and they hang up on you, no worries, it was a scam. It's very easy to scare people by using IRS. Don't let them scare you. If you owe, you'll know you owe. And what I always tell people is, if somebody calls you on the phone, and I've gotten those phone calls myself, it's very fun to have conversations with them, especially as a professional tax preparer and CPA. But if they call you on the phone and you don't know the answer, you're not sure if this is legit or not, what I always tell people to do is give them your tax preparer's number. Or tell them, give me your information and I'll have my preparer call you back, because they have that information. Normally, if it's a scam, that's going to scare them right then and there. Okay? Anybody who's calling you on the phone demanding money is likely a scam. Be careful and let those people that are older than you know. A lot of times right now, unfortunately, our elderly are the ones that are caught up in a lot of these scams. Make sure that they know that they should absolutely not respond to things like this, okay? So Tuesday, April 18th, because we have Emancipation Day, so Tuesday, April 18th is our tax day this year. Don't wait until Tuesday, April 18th, please, because us tax preparers really love when you're not waiting until the last weekend before tax time. So if you cannot get your stuff together before that, file for a 6-month extension. If you have it done early, even if you owe money, you don't owe until April 18th. So if I file your taxes on March 1st and you owe $4,000, you still have the time to pay it, but at least your tax return is filed, okay? And you're still gonna pay penalties through April 18th regardless, if you owe them money. So one of the things that I always say is the information in the presentation is for a general audience. If you have specific tax questions about your specific needs, definitely talk to a professional tax person. I've put my email up here as well as my information, so I'm happy to take questions. I do prepare taxes, I do teach taxes, so I do know the tax law, but it's important that somebody doesn't give you an answer off the fly and then you go with that, because the IRS is gonna say, well, you shouldn't listen to them. They need to look at your tax information and be aware of it before they make those decisions. So, I finished a couple minutes early, but I'm here to take questions if there are any questions. No questions?
I have a question.
Of course you do.
Of course I do. So I noticed the deduction for married versus single. So single was $6,300, the standard, and married was $12,006. My simple math indicates that that is simply double. That doesn't seem to be much of a difference. Assuming you don't have any children, nobody's in school, what would be the advantage of filing? Is there an advantage to filing together? Assuming, I know it's mostly those credits that you went over, but if you're not eligible for any of those credits because nobody is in school, nobody has any mortgage, tuition interest, nobody has any children.
So if you're married, you have the option of married filing
Single
jointly.
or married filing jointly, yeah.
So if you file married filing separate, all of your deductions are actually half. And so if you itemize because you have a house, but your spouse doesn't itemize because the house belongs to you, he has to itemize. So if one itemizes, the other has to itemize.
Really?
Yes. So what happens is, while it doesn't hurt you as a single person to each be single, once you're married, if you decide to file married filing separately, you get the deduction as though you're still single. Each of you get that deduction, but everything else, your itemized deductions, credits, everything that you would normally get is split in half. So it is not beneficial for you to file married filing separate unless you have one spouse who makes an enormous amount of money, and the other spouse who has maybe a lot of interest income. There may be, I've had some very, very big clients with very big pockets, and I still could not find a benefit to the married filing separate. And that's kind of what the IRS is saying. And that's why they call it the marriage tax, because if you're going to split yourself up in that way.
So the assumption is that you would actually share with your spouse what approach you are using so that they would know.
Right.
Very good.
But again, if you're living separate for a year and but you're still considered married,
Yeah.
and you're filing separate, and people do this. I may have the house and say, well, sorry, dude, I'm going to file my taxes really quick. File itemizing because I get everything, and you're stuck itemizing. Now, think about it. If he's stuck itemizing, then he can't actually take that $6,300. He can only take what he can actually itemize. He has no house, he has no medical, he has no real estate tax, he has no job expenses. He's kind of taken zero, and I took a big deduction. So that's the unfortunate side to that. Like I said, I've done in the 22 years this year that I've been doing taxes, I don't think I've ever filed a married filing separate that was for the benefit of the couple. Anytime I've ever filed it, it's because one spouse is missing
Yeah.
or something to that matter.
Kill him. Misplaced the spouse.
They come and they just say, my spouse has been gone, so here, file my taxes.
I'm married to someone somewhere.
Someone somewhere a long time ago.
Yeah.
Okay, great.
Any questions?
I had a question on the earned income credit, where it was $15 billion in errors and fraud. Like, where? I'm not an accountant. I pretend ever to be one. Where did that all come from? Like, is that many people in this country not being honest on their tax returns?
And you need to remember that the last 3 years were the 3 highest years in fraud. People filing tax returns for Social Security numbers that didn't belong to them. So they were filing tax returns and they would make sure that they were under that dollar value, and then they would file and get that additional $6,000 for their taxes. Well, we had one guy in Nigeria, I believe, who filed, he filed 100,000 tax returns that were fraudulent, and to get that EIC credit. So there's quite a bit out there.
And so this country sent that money to Nigeria?
No, they send it somewhere local.
It's like the opposite of that. So
Bank
That's when they
accounts.
link up the bank account.
Yep, bank account, there it goes, and, so there's that. There are a lot of fraudulent situations though in the US where people will, for example, if I am making some money and my boyfriend is making some money, no, I don't have a boyfriend, but I'm just saying, my husband's sitting in the room, so, if he's filing something and we're both filing head of household, and I'm taking one child and he's taking one child, and we're both filing head of household earned income credit, we're both getting back that money, and we
We're
shouldn't be
double-
getting it.
You're double dipping.
You're double
It's the
dipping.
same kind of household and the same children.
Right, right. So, and that's really where a lot of the fraud comes from, is it comes from people filing when they shouldn't be filing to get it, or I file, or we're separated and I file getting the earned income credit, you file getting the earned income credit. The IRS is not matching these things up, and they're just putting forward the money.
So, but the earned income credit, that's for people that are, that get tax benefits because they don't meet a certain income.
Right. So they make low, but you have to have earned income credit, and that's another question that I do get a lot is, well, I have Social Security, disability, whatever, I didn't really work, can I still file and get the earned income credit? No, you can only get the earned income credit for money that you actually have in W-2 wages or a legitimate business. And the thing with filing earned income credit, if you say you have a business, is you need to be able to prove that. Because that's the other place the IRS is looking, is people who, let's say you stayed home and you didn't work at all, and you collected from the state or whatever, however you get child support, and all of a sudden you say, well, I have a business. So I made $6,000 at my business, so I have earned income of $6,000. Give me back my $12,000 tax return or whatever it happens to be.
Is that where like minimum wage people get bumped up because they're under a certain amount too? If I work at Walmart and I make minimum wages $11 an hour?
Yeah.
And then I would be able to apply for earned income credit because I've got 3 kids. And
Right, so you can actually file so that you're not paying taxes each week. Instead, you're working off this earned income credit that you would have gotten at the end. Yes. So, and that problem is, let's say that you worked at Walmart for 6 months and you did that, and then all of a sudden somebody comes in and says, you're a great customer service person. I'm going to pay you $30,000 a year. Come work for me now. And now at the end of the year, you've made too much. You have to pay that money back. So that's one that you need to, if you've had it on a constant basis, it's one thing, but if it's new to you, then don't go into your employer and say, I'm gonna take this earned income credit ahead of time.
Alrighty then.
Good questions. All right. Well, as I said, that's my information. If there is something that I can help you with on a general basis, I certainly will. If you really love taxes and you want to know more about it, NECB does offer a federal tax class, which runs once a year, right before tax time, so it's perfect. It's updated every year to follow along with the new rules and regulations. And I'm happy to tell you more about it if you want to send me an email. Thank you, everyone, for joining us. Good time. We did it.